Welcome back to Business Today, and we are ready to move on to our next discussion, the final discussion for today, and we will talk about an area that we all associate with, and that is insurance sector. And we got Mr. Raghuram Ramakrishnan joining us today, representing NDB Securities. A very good evening to you,
Good
Raghu.
evening, and happy to be here. Thanks.
All right, so to start things off, could you first talk about the current position of the insurance industry in Sri Lanka and how Sri Lanka has performed compared to the region?
Well, before I get into the insurance sector perspective in the country, let me go through with the introduction to the insurance product. Insurance products are something which offers protection against losses in as far as life insurance is concerned. Insurance products are supposed to be giving the risk transfer methodology, which transfers the risk of the insured towards the insurer for exchange of a premium. There are actually two types of products, insurance products. One is life insurance product and other one is non-life insurance product. If you take life insurance product, which offers a protection against the loss or partial disability of a person's human capital. Human capital is something is defined as the amount of wealth, quantum of wealth a person can create during his or her lifestyle. So which gives a protection for that. If you look non-life products have lots of varieties, and what it offers is it gives a protection against the losses and casualties for the properties of a person, the assets or properties of an insured person. In Sri Lankan context, if you look, there's one of the mainly used insurance criteria used by analysts to gauge the insurance sector penetration, or how far the insurance sector have developed in the country. That ratio or that rate is known as insurance penetration rate. How that has been calculated is basically you have to take the total premium income, which is one is coming from the life insurance, plus you have to add the non-life insurance premium, and that divided by the total GDP of the country. So that will give how far your insurance sector has penetrated into the country. So in Sri Lanka's case, it's about 1.24%.
Isn't it quite low?
Which is very much low. To put into perspective, if you look the averages of world, Asia and Asia emerging, that stands around 6.1, 5.6 and 3.7, whereas Sri Lanka, we are standing only at 1.24%. If you actually look, there's the general connotation that people say the countries like us, countries like developing countries, countries like emerging countries, the insurance premium is supposed to grow at a very fast rate than the GDP growth rate. But that is not been true in Sri Lanka's case. If you look from 2000 up until 2016, the insurance growth rate or the GDP growth rate of the country was around roughly around 15 to 16% combined annual growth rate. If you take the same period, how much the total insurance premium have grown in the country is roughly around the same percentage, about 15.2%. For a small country like us and with so much of growth potential, why Sri Lanka's insurance sector hasn't been lived up to the expectation? Questions might arise. For that, we believe, okay, GDP been growing at a fast rate, we have so much of potential, but the penetration is still at low level, which we believe the cultural position of Sri Lanka. As we all know, in Sri Lanka, we operate or we accustomed to a culture that we have very much extended family. So in extended family, what happens is the elder generations been very much looked after by younger generation. And on top of that, Sri Lankan successive governments have these policies of giving a free healthcare system. So hence the general public, if they have any healthcare related issues, they don't need to worry about the financial hardship that they have to go through. They can go for a free healthcare system in Sri Lanka. So that's one reason why the public hasn't looked into insurance sector as a whole. But going forward, we expect these scenarios to change a bit. On top of that, supply side issue, because we don't see much of awareness among the public about the insurance sector products as well as its benefits. And another practical issue that we face when you go for a life insurance coverage, the terminologies or the policies, documents and all pretty much complicated to read and understand it. And on top of that, there are not much of sophisticated or customized product on the offering. So these are a few reasons what we believe Sri Lanka has so much of potential to grow, but that has been captured, properly addressed in. So there are so much of unlocked potential going forward in the insurance sector. If we can address that accordingly, we can actually, the insurance sector in Sri Lanka can be a game changer or can be a good sector going forward.
All right, so you spoke about the two main segments in insurance, that is life insurance and non-life insurance. So if you concentrate on the life insurance sector, can you talk about its current context?
Yeah. So again, if to get into a perspective of life insurance, how Sri Lanka has penetrated into the life insurance segment, again I have to get what I've previously alluded, which is known as insurance penetration rate. So in Sri Lanka, within the life insurance segment, the insurance penetration rate is only around 0.54%. Again, one of the lowest compared with our regional countries. You take world, Asia and Asia emerging average of 3.3, 3.7 and 2.5, where we stand at 0.54%. And for a fact, if you take among the population, in Sri Lankan population, if you take those who have life insurance policies, it's only about 13.7%. And only 1 out of 3%, 3 working population class have the insurance policy. So which is again one of the lower. Going forward, we have to address those issues. But having said that, we expect there will be a lot of demand to be created in this life insurance segment, mainly because Sri Lanka as a country, we are going through an epidemiological transition period. So the foremost reason why I'm saying that is a non-communicable disease. We all agree on the fact that Sri Lanka's government's free healthcare and free education system actually have made our healthcare system very superior to the regional countries. So that's why we managed to control the communicable diseases to its lowest level. But now we are facing an issue that is coming through non-communicable disease. The non-communicable disease is inevitable and it's kind of a lifestyle issue. We can understand with the increase in wealth, increasing in the per capita income, and of course with very demanding working condition in the service sector of the country, Sri Lankans are increasingly getting very much prone to get in the NCDs and once in their lifetime. In fact, if you take back in year 2014, the non-communicable diseases have actually accounted for roughly around 75% of the death, and that is almost in line with the high-income countries' death level of 80%. When I say high-income countries, the countries like UK and USA have death rate about 80%, whereas Sri Lanka is about 75%. So Sri Lankans, with the increased level of wealth, they are getting into a very sedentary lifestyle. While the government with its amenities and its line ministry trying to battle against this non-communicable disease, the general public meanwhile have to go for the regular public health checkups, because as well as they have to go for a laboratory test. But we all understand and we all have experienced that Sri Lanka's private healthcare, the expenditure, I mean, it's pretty much increasingly becoming unaffordable for an average Sri Lankan or middle income population. That's one reason why how can we come out from that is going for insurance. If you take in year 2014, out of the total healthcare expenditure that has been taking place in Sri Lanka, roughly around 55% of the expenditure are being done by the private sector. And among the private sector, roughly around 88% of expenditure came through out-of-pocket expenditure. Out-of-pocket expenditure is basically defined as the money you and me pay for our own bill by own money. If you look the world average, which is about 50, and where we stand at 88%. And another important factor arises, okay, how much insurance have contributed in these expenses. In Sri Lanka, which is only about 5%. If you look
5%.
only 5%, but if you look that with the lower middle income countries, we are in lower middle income countries at the moment, the 5% seem to be okay. But in 2 years, we expect to move into upper middle income country. But if you see the gap between lower middle income and upper middle income have 17% of it. And the world average is about 35%, and high income countries has 50%.
That's quite a gap.
Very much quite gap, and we are at 5%, and the world average is about 35%, and high income, forget about it, which is 50%. So 5% only the insurance have paid for the healthcare bill. So that we believe going forward, this general public or Sri Lankan public with this non-communicable disease on the rise, they might opt for a life insurance coverage. The other reason why we believe the life insurance product in Sri Lanka would have immense of growth going forward is because of aging population. As we all know, as a country is almost all the world countries, especially the developed world countries, is facing this issue, aging population. The countries in the EU and the countries like Japan. In Japan, of course, around 1/4 of a population is about the aging population. So Sri Lanka also getting there. At the moment, Sri Lanka's population's aging population rate is about 12.5%, and that is estimated to be around 16.1% in 2022. So this will bring in a new risk called longevity risk. Okay, if you ask what is longevity risk, is a person have a financial asset, and if he tend to live longer, then his financial asset will run out, and he will not have any money to look after himself. So what would be the solution is annuity. It's again an insurance product. Annuity is something which gives you financial support every year. and that can be a pre-specified period, like you can have it for 20 to 30 years, or you can have it until your lifespan. In Sri Lanka, you won't heard, or you are not, we haven't seen much of annuity kind of products, but in the developed countries, to tackle this aging population, they are coming with this annuity kind of a product. Going forward, we expect these two reasons, non-communicable disease plus aging population, might drive the demand for life insurance product going forward.
Right. So before we move on to the next question, can you touch a little bit, very briefly, on the non-life insurance segment and its future outlook?
Correct. Again, I'll have to go to rescue for the insurance penetration rate, but insurance penetration rate in the non-life segment is about 0.64%. That is quite okay when you compare that with the life insurance penetration rate of 0.54. Again, even though we are on line with our regional countries, we are still lower than the world and Asian average. Okay, why this non-life segment has so much of penetration than the life insurance is because of motor insurance. We all know in Sri Lankan roads, if we have to drive a vehicle, we need to have a license for that. So basically known as motor insurance. Motor insurance alone contributes about 65% of the overall written premium in the non-life segment, which is one of the highest when you compare with the countries, regional countries. And if you compare that with the developed countries like UK and Singapore, they have nearly 1/3 of it, roughly around 30 to 33% of the motor insurance. 33% is coming via motor insurance in their overall non-life business segment. But if you take the countries like India and Malaysia, the rate is about 45 and 55%. Sri Lanka, we are at 65. That brings in called concentration risk, because our non-life players are mainly concentrated on one segment for their business. The question might rise, okay, why Sri Lanka has highest percentage of concentration whereas other countries have lower, is because they have the series of other product offering as well, especially fire and health business. So we believe fire and health insurance policies in other countries is growing at a faster rate than the motor insurance in Sri Lanka. But going forward, we expect a health insurance to play a major role due to the reason why I have earlier alluded. And on top of that, if you have noticed, now it's becoming an industry norm for the employer to give health insurance as a compensation. So that will drive the demand for health insurance, along with the reason what I said earlier. And the fire insurance is, we have witnessed along the western province, there are a lot of apartment units are mushrooming. And according to our Condominium Act, all these apartment units supposed to have the fire or property insurance. And on top of that, we note our middle income is actually getting bigger, and the mid-level professionals are now trying to get their first houses. So they want to build the houses, so they want to buy the houses. Most often than not, once they decide to go for their first house, they'll obviously go for a bank loans. From the moment they go for a bank loans, bank requires them to go for a insurance. So we expect the fire insurance to go up because of that. And to support that argument, if you look, the household debt to GDP, that gives how much of loans that Sri Lankan can take further, is at around 8.7%, well below 10%. When you compare with the countries like India and Malaysia, India has 65% as the household loan, and the Malaysia has about 87% as a household loan. So we believe the fire insurance and the health insurance will drive the growth rate of non-life segment. The motor insurance, we don't expect to have a double-digit growth that you used to have in the previous years, because the country want to control their importation. Due to this reason, we expect that to grow at a mid-single level, whereas fire and the health insurance to grow at a fast rate because of the reason I've been mentioning here.
Right. My final question to you is, there are key factors affecting the performance of the insurance industry. So can we talk about the level of competition, the regulatory measures in place, and also the profitability, very, very briefly?
Competitive landscape, if you look at the competitive landscape of the insurance sector in Sri Lanka, there are about roughly around 27 players in the operation. And out of which, of course, for a country with a 21 million population, having a 27 players is of course overpopulated market. But which segment, life or non-life, will get most affected is non-life segment. Because average policy of the non-life segment is just 1 year. And as a client, we have the option to switch to a client. If we are not happy with one player, we can shift to another player. And that's the reason And the small players want to have the market share. What they do is they write a premium that's not commensurate with the risk that they're taking. So end of the day, they're coming up with the operating loss. In manufacturing companies known as operating loss, but in insurance terminology is known as underwriting losses. The question might rise, okay, how they can run with underwriting losses for so much? Because life insurance, they cover their losses under the life insurance profit. Life insurers, of course, have average policy around 20 plus 30 years and fairly large time horizon, and of course they get premium income and they'll invest that into the financial asset that yield higher return for them. So life insurance companies in Sri Lanka are profitable. So what they do is, as an entity, so they hide the life insurance profit, they hide the non-life insurance losses under the life insurance policy, merely accounting term known as consolidation. So the IRCSL, Insurance Regulation Commission, have seen that, and back in 2015 they come up with the regulation. The composite company which are in the insurance business have to separate life and non-life business, and they have to report their financial as a separate entity. With that, they also come up with the regulation. They've increased their minimum capital requirement from 100 million to 500 million. With that, they also come up with the regulatory impact that they have to shift into a risk-based capital from the solvency margin they used to have. So risk-based capital is something, if your company takes so much of risk, then they need to have a higher capital base. So the smaller players already making loss, now they have to separate as separate entity, couldn't able to cope up with these regulatory issues, and hence were looking to sell it off. That's why we have seen so much of consolidation that finally is being taking place. The Canada-based Fairfax Asia Limited and the Germany-based Alliance companies are going behind this the acquisition spree, and they've been taking over this company. So which is a good sign, because the consolidation needed for the non-life segment, and going forward we expect life insurance company to be profitable, whereas non-life insurance, if the number of players comes down, it can be beneficial as well going forward.
Right. Thank you very, very much, Raghu, for being with us, and for this detailed evaluation of insurance sector. Thanks once again.
Thanks a lot. Thank you.
Yes, with that we got to wind up for today, as we are on a constant battle with time. So take care and good night until we meet you next week, same time on Channel I.